Good morning and welcome to the latest special edition of the Sharesify podcast. Now, we're delighted to be joined today by Iain Pyle, co-manager of Aberdeen Equity Income Trust. Now, Iain was previously manager of Shires Income, which merged with AIE, and he also manages UK and global income portfolios. Iain, welcome to the show.
James, Iain, very good to be here. Thank you for having me on.
Excellent. Now, interestingly, for a trust which aims to deliver an above average yield, your philosophy is focus on change. Now, this is where you analyse corporate situations to uncover value the market hasn't yet recognised. Sounds a little bit more like a special situations fund. Can you just talk us through that subtlety?
Yeah, sure thing. I mean, it does sound a little bit like that at first glance, but I think the truth is a little bit different. When we talk about focus on change, the genesis of that idea was really that if you want to own value stocks where the market is perhaps undervaluing them, then you need to have a difference to consensus. You need to have a view that is different to the markets. And the theory is really that those differences to consensus really come out around points of change for a company. That's when you're more likely to have a view that is different from what the market thinks, and you're more likely to make money, to be honest, owning those positions. So what we're looking for is not so much those kind of point events or distress situations you might find in a special situations fund, but we're looking for slightly longer term corporate change or change opportunities, either that we can see or that the management team are telling us about that the market hasn't yet seen, or we can see the potential for them to happen in the future. And that way, when we look over maybe 1, 2, 3 years, we expect to see that combination of good capital growth from the stock, dividend growth, or maybe a high dividend yield where the yield compresses and we make money that way.
Right, I got you. Yeah, so it's, I mean, we know that value in and of itself doesn't necessarily make a good investment. You know, things can stay cheap for quite a long time. You need some sort of catalyst. So you're looking for a turn in the business so that you get that uplift from earnings and then hopefully a re-rating. And does the re-rating necessarily follow the upturn in earnings in your experience?
Well, I think the great thing, Ian, is that if you see the earnings turn up, then we don't need a re-rating to get the shares moving up, right? The rating can hold and we'll do well. And usually we're buying things where we're getting a attractive yield up front as well. You know, the yield on the trust today is 5.3%. So you're getting a good return sometimes just by holding companies with high yields where that yield is maintained and compressed. And there's a number of examples in recent years, companies like M&G or Imperial Brands, where we've gone into them with a very high double-digit upfront yield. And they've been excellent performance just because the yield has compressed over time. Yeah. But you're absolutely right. The ideal situation is one where we find that earnings inflection, earnings go up, and then you get that double leverage of earnings going up and hopefully the PE multiple turning as well.
Right. And so how important are cash flows and cash flow yields when you're looking for investment ideas?
They're super important, James. I think, we're dividend investors and the dividend is an output of the cash generation of the company. So we focus on the cash. I think we recognize the fact that cash is the hardest bit for management teams to misstate or to manipulate through time. So that does matter. And we do look for companies where maybe the cash is going to be steady, but we're coming out of a CapEx phase, for example. And so as CapEx comes down, free cash flow goes up, and that ability to return capital to shareholders goes up over the investment period as well.
Right. Yeah, Iain, I think you had a question, didn't you, on in terms of the opportunity set?
Well, I was interested because you mentioned, Iain, that you bought some stocks on double-digit yields, and you see double-digit yields as, sometimes the market thinks that's a real red flag because there's something wrong with the company and that maybe they're a value trap, but that's not your approach.
Well, it's not always our approach, yeah. I think the trick is finding the ones where we know why the market has priced it that way, and it might be skepticism about the ability for the company to grow. It might be skepticism about the sustainability of that dividend. It may be just an area of the market where people don't want to look, or they think the dividend is going to be cut. If we can do a lot of work and we can get comfortable that actually the outlook for the company is somewhat better than that, then those double-digit yielders can be very profitable holdings. But you're absolutely right. A double-digit yield often does tell you something is not as it should be, and there is a risk there. So handle with care.
Yeah, James.
Yeah, excellent. No, I was just going to say, so one of the advantages of the trust structure is you can borrow money to invest. So you're about 10% net geared currently, I think. So how does that compare with your top limit? And when was the last time you had gearing at similar levels?
Yeah, that's a good question. I mean, we definitely believe that ability to gear up is a real advantage of the investment trust structure. And if you take a long-term view and you invest through cycle, markets will go up, and therefore using that leverage will enhance our returns. And in an income fund, it particularly enhances our income generation capacity as well. So it's a very useful tool of an investment trust. The leverage is about 10% at the moment. We took it up slightly a couple of months ago, and we can go as high as 20%. We're very careful about how we take that on, because calling the cycle is tough, but we try and be very mechanical about how we do it. So we look at a number of metrics for the markets to determine when we should add or take away leverage, and that's basically the earnings outlook for the market, the level of volatility. Is there a volatility-induced sell-off we can take advantage of? And it's also the cost of debt. So can we go and take on leverage at a cost that is below what we think we can make in the market by investing it? That's important as well. So we've cautiously edged it up. Over time, we'd probably be inclined to take it up a bit more, but we just want to find that opportunity where maybe the cost of debt is low, maybe market level presents an opportunity, and do it at the right time.
Right, yeah. I was also just going to ask Ian, the merger with Shires and what it's done in terms of the advantages. So has it kind of broadened the toolkit for you, or, and what are the sort of benefits to the end shareholder?
Yeah, so I think the merger, if I'm honest, has been a great success. I think these things are never easy to do, but it was a merger where we brought together two trusts with very similar investment styles, very similar outcomes in terms of high dividend and dividend growth, and created one trust which is larger scale, which helps on the ongoing costs for shareholders. So for equity income shareholders, the OCR has come down from about 0.85 to be capped at 0.78. For Shires, it was above 1%. So it's quite a meaningful saving there. As you suggest, it also brings some additional tools into the toolkit for equity income. So we can now have, alongside UK equities, we can invest in fixed income and preference shares. And that's helpful in an income context because what they bring is very stable, high levels of yield. So the preference shares that we hold, they all yield over 6%, and they're a very reliable source of that dividend. We're not going to get great capital growth out of them unless bond yields fall. But there's always a point in the market cycle, I think, where maybe bond yields are falling, you want some more defensive exposure, you can get high yield, which is defensive, which can be quite hard to find in equities. So there's certainly a useful tool in just diversifying the portfolio and adding a bit of resilience through cycle. And then the merger also gives us the opportunity to have up to 20% in overseas equities. And that focus on UK and UK value equities is not going to change, particularly because we see such good value and such good opportunities in the UK at the moment. But I think as a fund manager, you always want to try and remove the constraints and maximize your opportunity set. And just having that ability to go out of the UK where we see great income opportunities, particularly in areas where we can't find similar exposure in the UK, just gives us that extra ability. And when you get into the high yield part of the market, the opportunity set naturally gets smaller. So widening that just makes our job easier in terms of finding good companies and finding high yield companies which will grow their dividends over time.
Yeah, really interesting. I mean, I was just looking at the fact sheet for June, and it was a great 12-month run. I think up almost 30% since the beginning of July 2025. And June itself was a good month as well, because you've got CMC, which just you know, I mean, how many people, you know, had twigged that this was a B2B business, not just a B2C business?
Yeah.
And there's been this huge re-rating. EasyJet, obviously, we've had this sort of competing bids for, but also I found it interesting. You are still finding opportunities out there. So Coca-Cola Hellenic, which is one that James knows very well, and Vesuvius. What attracted you to those two?
Yeah, I mean, if you'll indulge me, I'll just quickly touch on CMC and EasyJet, 'cause I think
Please, yeah,
they tell us something about the process and the focus on change approach we mentioned
yeah,
at the start. And CMC, as you mentioned, is this great story of a business where they've built up a technology platform over time. It's got a fantastic business, could be quite volatile, but very high cash margin, very profitable. The market's perception of it was a retail spread betting platform, which
yeah,
comes with volatility and it comes with risk. And our perception, and Thomas has known this one for many, many years and knows it extremely well, was that you need to slightly shift that to get the market to value the technology and the replicable earnings from that. And what they've done very well is deliver this business to business transformation, sign contracts with, for example, some large Australian banks where they go behind the scenes, cost to acquire customers is very low, and the scalability and the operating leverage on their platform is extremely high. So you've changed the underlying quality of that business and the market's perception of the growth potential very quickly. And the shares, as you said, have done extremely well. And that's a great example of that focus on change and an underlying change story that the market maybe didn't appreciate. And EasyJet, I think, is an example of our willingness perhaps to hold cyclical stocks through cycle. I mean, I think one of the great advantages of the investment trust structure is that you're never a forced seller. You don't have people taking their money out, so you need to liquidate positions. And EasyJet, we liked the long-term change story of fleet reinvestment happening. When that ends, we'll see free cash flow expand. And at the same time, building out the holidays business, which is higher return on capital, higher quality than the underlying airline as well. Obviously, you had a period in the start of this year where the Iran conflict started, oil prices went up, and of course, the market chucks out airlines when oil prices go up because you're going to see margin compression in the short term. But what you know is that if oil prices are high, they're probably going to go down. If oil prices are low, they're probably going to go up. And the worst thing you can do is sell EasyJet at that point. We would have held on to EasyJet, and I think it would have worked out fantastically well for us. The fact there was two bids for it in the interim, basically pulling forwards their longer term earnings guidance, means it's played out much more quickly than we would expect. But it's really an example of that investment case just happening in a slightly different way than we would have anticipated. That ability to hold things at cyclical lows and hopefully try and buy things at cyclical lows is really powerful. And then the two new names you mentioned, CCH, so Coca-Cola is a big Coca-Cola bottler, and we sometimes struggle to find consumer staples exposure because the companies tend to be slightly more fully valued, slightly lower yield. CCH is reasonably valued, good yield, good growth profile. We've known it for a long time and has an excellent management team who have been successful at growing their market share and extracting value from their bottling businesses. And I think what got us over the line at the moment is the upcoming transaction they're doing to take on one of the biggest African Coke bottling businesses. That gives them exposure to about 50% of the African population. And we expect them to then use their skills and their abilities to go into those markets, grow market share, grow share of the wallet in markets that have generally been pretty underpenetrated and have good underlying growth. And what that means, we'll get a business with about 1 percentage point higher top line growth and improving margins over time. Another great change story where we expect to see good outcomes for the shares. And then the other example, Vesuvius, this is one which is off to a slightly challenging start. They make foundry and steel processing equipment. And the attraction for us is that we're going through a period where the European steel market in particular is going to improve because we've seen tariffs put in place on incoming steel into the EU. And at a time when we're also getting increased infrastructure spend, increased deployment of capital in Germany, for example, if we look far enough out, hopefully we'll see a rebuild of Ukraine if that situation comes to an end. The outlook for the European steel market is definitely better. And Vesuvius benefits materially from those end customers needing to invest in new equipment. They have leading market positions, particularly in flow control in that market. And that's going to come through into a better end market, better margins for Vesuvius in a business on less than 10 times earnings, which looks very cheap for its market position in our view.
Yeah.
They actually had a profit warning last week, so shares were down almost 10%, and that's slightly unfortunate. It slightly pushes back the investment case, but if you read the statements, what you're seeing is actually the underlying market is doing exactly what we'd hoped it would do.
Yeah.
If they hadn't had some internal operational issues, then actually we would have had a really good print this half year. We're going to have to wait a bit longer, but I think our enthusiasm for that investment case remains exactly the same as it was.
Brilliant. Brilliant. Well, Iain, it's been great to catch up with you. It's been far too long, and I've got some questions as well about some consumer stocks, asking for a friend, as they say. But we'll have to leave it there. If you want to hear and read more about Aberdeen Equity Income, go to the Aberdeen website. It will have the latest fact sheet on there next month. And with that, we'll wish you all a good day. Thanks very much indeed for your time, Iain. Cheers.
Thanks, Ian. Thanks so much, James.
Thank you.